Hey guys, it's a market update. In this video, I want to go over some of the latest macro data and how it's going to affect Bitcoin and crypto over the next few weeks and months, because we're seeing a lot of this type of data come out, which is global default rates seemingly getting a bit higher, right? So economic stress. We're also seeing bankruptcy filings, which is pretty much the same data showing, levels very high comparative to previous crises, essentially. We're also seeing interest rates on the long end go parabolic. This is 30-year government debt for the US Treasury debt. And as rates go parabolic, that means the price of that debt is crashing. Now, as that crashes, financial institutions are stressed. This is showing financial stress within a lot of institutions who are having to dump bonds to meet liquidity concerns, etc. So this is potentially starting to get out of control, and that's when they start to step in again, and Bitcoin's going to react to that, in my opinion. Is it negative or positive? Let me explain that throughout this video. In terms of Bitcoin, where we are right now, I'm not actually too bearish, to be honest. There's a few things here. The first is, yes, we did break this 200 period moving average. This is the 200-day moving average. However, I do believe the general trend is more to upside or neutral, right? We've had the move of this year. This is the pre-halving year part of the cycle where you get a decent bounce in every previous cycle. We've had it here, right? A big move to the upside here. We're kind of done. I think expecting massive moves at this point is not going to happen, right? So we've already had that move. We're up 65% or so. That's a great move for a pre-halving year. And it's really the halving and then the year after the halving where you potentially get big moves. And that would coincide with what I would say as the turn in the macro cycle as well, where the Fed and other central banks are going to be worrying about growth. You're seeing all of the data come out, right, in Europe. And then even S&P is saying, US growth is a bit slower than we expected. So as that comes out over time, potentially easier monetary policy. And I think the cycle is playing out again. Short term, I would want to break this 200 MA and probably play a short-term upside bounce. However, this 32 is a massive resistance, and I wouldn't want to be buying it right now. I think the time isn't now to be buying this, but I'd certainly be trying to buy breaks of this, or maybe if we get some rejection down here, I'd wait to see some bounces here to actually buy short term. But long term, just still remaining diligent, dollar cost averaging at these levels. If you are a trader, check out Bybit, link in description. You can get a deposit bonus up to 30,000. Just click the link for the details down in the description. I want to get onto this macro data showing defaults and bankruptcies and how it might affect the price of BTC over the next 6 months or so if you're in this or you're looking to dollar cost average. First thing is, we're seeing year-to-date default rates in the US and Europe already above 2008 levels. Interestingly, this is barely getting any attention. We are on track to see more defaults in the US and Europe this year than all years back to 2009, other than 2020. In 2023 right here. Recession, right? Recession fears, again, another growth slowdown. So remember, we had two quarters of negative GDP growth in the States, and everyone was saying that was the recession. The US government said, no, it's not a recession. We now are calculating it a different way. Okay, that's fair enough. Are we going to get those negative GDP quarters again? I don't think it matters that much. Here's why. 2008 was the crisis. That was here. Not many defaults. 2009 is when the defaults came. That is a lagging indicator. Now, let's also look at 2008 and 2009. So defaults came in 2009, especially in the US. So let's look at 2008 and 9 on the chart right here. And it's all the way back here. 2008 was the crisis, which was here. 2008 crisis happened, stock market came off. This was a huge fall off at the time. You're looking at 50-60% from the highs maybe. But 2009 was when the defaults came right here. The market bottomed at that point when the defaults were coming and actually started to rise again. Now, why is that? Bankruptcies are lagging data. That's economic timing. Markets look forward and they're pricing in what was, as we know now, monetary debasement, support of the economy, right? Credit creation. That's the next part of the cycle. So that's 2008 to 2009. So what we're seeing is this data is lagging. What we're also seeing here in 2023 is a spike, yes, but nothing major in comparison to previous, right? I look at this data and I don't see a massive, huge rise, considering we feel we're in a growth slowdown or a recession, right? Here's the financial crisis. So a spike in bankruptcy filings. We see that during the pandemic, and then we see it again. But if we look to the pandemic, so we've already seen the financial crisis, bankruptcies are a lagging indicator. Markets look through that. They look through to the next part of the cycle with easier money. Now we're seeing that it's actually midway through 2020, almost into 2021, that you actually get the spike in bankruptcies, which is this here. So yes, you got a huge drop in the stock market, and then as the bailouts come and as monetary policy eases, look what you get. Now this was obviously a huge stimulus, but the direction is quite clear. Bankruptcies are lagging, and the market usually over the last 2 times has actually risen on those because it looks forward to monetary policy becoming easier and the next part of the economic cycle. This is one of the largest and longest bear markets in the NASDAQ in history. Now, 2008 was obviously awful, but we had a huge drawdown and we've bounced as well. Why? Well, 2023 right here that we're in, we saw the bottom, and then bankruptcy filings are peaking again. But considering they're a lagging indicator, it doesn't mean that these bankruptcies are going to see us down towards these lows, right? So the market's looking forward through that. We've had a huge run. You would expect after this, basically a straight line up. This is the NASDAQ, by the way. I just think it's a better proxy. After such a massive run up, you would expect profit taking here. Seasonal weakness, profit taking down. So we are still, in my opinion, within some sort of recovery or neutral market structure. We're not in this kind of fall off. Now, that could happen, of course, and the Fed could drive us into that. And so that could happen. But if they do, then what's going to happen the other side of that? It's just even more stimulus or some sort of support, because they can't have GDP going negative for too long. They can't have GDP down below 2% for too long. So the bankruptcy data and all that economic data is lagging, and markets seemingly are looking through this to the next part of the cycle. We're seeing it play out. It's very muddy because we're not in the bull market part of the cycle. It's muddy and murky and a little bit stop-start, but that's the part of the cycle that we're in. It looks like it's playing out, in my opinion. The real question we have to ask ourselves if we are in Bitcoin is, when does the money printing come back, right? Because that's when you get those bull markets, 300, 400, 500%. You can see that, economic growth is expected to slow down to maybe 1.7, 1.2. It's all kind of boring. It kind of doesn't make any difference. What we're looking at is there going to be a huge financial crisis where the money printing comes back? Now, if you're in Bitcoin and you're seeing an economy that's growing around 1.5%, Bitcoin's growing way faster than that as a network in terms of its network adoption. So you're going to be outperforming the economy. You're going to be outperforming the S&P. If money printing occurs because of a financial crisis, you're going to be outperforming everything because Bitcoin is that trade. So both ways, it's a world market index, and it's going to outperform both ways, in my opinion. But this is the chart really, because what this shows is that, pension funds, annuity funds, retirement funds, other types of funds that have liabilities to pay out are seeing that their risk-free assets, government bonds, are actually down like 60%. These are long-dated 30-year treasuries. If you bought a treasury in 2020 when the interest rate is 1%, it's now 4.6%. You've seen around a 50 to 60% drawdown in the current value of your assets. These financial institutions, if this keeps happening, are going to be under significant pain. And so we have to keep an eye on this, and we have to hope that a financial crash doesn't happen. If it does, Bitcoin, is going to protect you against it. And if it doesn't, it's going to be growing faster than this garbage, 1.22%. Right, so let's have a look at the Fed's BTFP. This was the bailout through the back door of all of the regional banks and other banks who could essentially sell the debt that was getting sold off. And they were making huge losses and having to sell it because customers wanted their money back. And so instead of selling in the market at a loss, these banks can just sell it back to the Treasury or the Fed at par. Now, right, so no loss there. It's not actually growing that much, right? So it's not getting out of control. It is growing on a weekly basis, but that was the time, right? That was the financial crisis, and it seems to have been contained for now. Happened in the UK as well. Now we keep an eye on this, but for now things are potentially contained. There's a lot of weakness and a lot of stress, but let's see if this spikes. Now, another reason why Bitcoin I think will do well is because they've already stepped in. This has already been bailed out. The BTFP exists. The bailout already occurred. This is it. This was the bailout. This is the government going to the banks and saying, all of that stuff that's just gone down 20, 30, 40%, sell it back to us at par, no problem. But it's really about this government bailouts, slow growth, you're going to outperform with Bitcoin, in my opinion. And if bailouts occur, you're going to outperform, because when the bailout occurred, Bitcoin rose and it's now up 60% on the year. I want to quickly show this as well, because the Fed keeps saying higher for longer. What on earth does that mean? Higher than what and longer than what? Usual cycles take place. The average time between the last Fed rate hike and the first rate cut over cycles since 1980 is 5.5 months. Okay, so from here, this time, September, October, you're looking at 5 to 6 months out, which just so happens to be around the time of the Bitcoin halving. So Bitcoin halving, rate cuts potentially coming, looser monetary policy, it's all setting up. I don't know the ins and outs and the daily price movements, but the cycles just seem to be playing out pretty well compared to previous cycles as well. If you are a trader, check out the Bybit deposit bonus down in the description. You can make a deposit trade, you get a big deposit bonus down there. Check out the Crypto Investor course, I'll link it down in the description. 300 videos on getting set up in crypto, private Discord groups, and I update the course for free for existing users with all my latest research, so check that down in the description as well. I'm James, it's MoneyZG, cheers for watching, and I'll see you in the next one.